Welcome back to the deep dive. You know, in the world of big business, when one company acquires another, it's not just about blending operations. Something else often pops up on their books. This fascinating, often kind of misunderstood financial asset called goodwill. But here's the big question, right? What happens when that goodwill isn't quite as, well, good as it initially seemed?
At the core of it.
Today, we're taking a deep dive into the critical and, frankly, a bit mind-bending world of goodwill impairment. You might think accounting is just, spreadsheets. But it's packed with hidden complexities and really crucial decisions that paint the picture of a company's financial health. Our mission today is to give you a shortcut to understanding how this intangible asset is calculated.
Right.
Why it absolutely demands, well, basically an annual checkup, and how a seemingly minor accounting choice right at the start can lead to a huge difference in how financial hits are reported down the line.
And we'll be drawing our insights from an expert article that pulls directly from IFRS 3 business combinations and IAS 36 impairment of assets. So yeah, this deep dive should offer you a fast track to grasping the nuts and bolts of this complex area, hopefully making those financial statements click into place a bit more.
Okay, great. Let's unpack this then. We've used the term goodwill, but let's make sure we're all on the same page. When a company buys another, what exactly is this goodwill we're talking about?
Right. At its core, goodwill is essentially the premium paid over and above the fair value of a company's identifiable net assets when it's acquired.
Okay, premium.
Yeah, think of it as the value of things you can't easily list out and price individually. Like, a stellar brand reputation, a loyal customer base, a uniquely talented workforce, maybe some proprietary tech that isn't formally patented yet. It's really the future economic benefits flowing from these sort of unidentifiable assets.
So it's not just the desks and the patents, but the whole vibe, maybe?
Yeah.
The secret sauce of the company you're buying?
That's a good way to put it, yeah. The secret sauce. Now, our source highlights that under IFRS 3, there are two key ways to measure non-controlling interest, or NCI.
NCI, right, the part you don't own.
Exactly. When you're figuring out this goodwill after acquiring a subsidiary. And these two methods are really quite different in how they approach it.
Okay, so how do they differ? What's the first way?
The first is the proportionate method. The NCI, that portion the parent doesn't own, is valued based on its share of the subsidiary's identifiable net assets. So just the book value, essentially.
It's its share of the identifiable net assets.
Correct. And what's key here is that any goodwill recognized on the consolidated financial statement under this method is solely attributable to the parent company. It's just their piece of the goodwill pie, so to speak.
Okay, only the parent's goodwill shows up in the second approach.
That's the full goodwill method.
Yeah.
With this one, the NCI is measured at its full fair value, not just its share of net assets, but its market value.
Okay.
Its fair value. Yeah. And the big takeaway here is that the goodwill recognized encompasses the entire subsidiary, meaning it includes goodwill attributable to both the parent's interest and the NCI. That's a whole pie this time, including the NCI slice.
Right, the whole pie. Okay, to make this really tangible, let's maybe look at that example from the source. Imagine Burrow acquired an 80% stake in High for $500. At that time, High's identifiable net assets were valued at $400, and the fair value of the NCI, that remaining 20%, was $100. How does the goodwill look under each method?
Okay, so if Burrow chose the proportionate goodwill method, they paid $500. The NCI share of the net assets is 20% of $400, which is $80.
Right.
So you take the $500 paid, add the $80 for NCI, and subtract the $400 in net assets. That gives you $180.
$180 goodwill.
Exactly. And remember, under this method, that $180 goodwill is only Burrow's share. It belongs entirely to the parent.
Got it. And if they use the full goodwill method instead?
Well, then it's simpler in a way. You take the $500 paid plus the NCI's fair value, which the example gives is $100.
Okay.
And again, subtract the $400 in net assets. So $500 plus $100 minus $400. That gives you $200 in goodwill.
$200 this time.
Yep. And here, that $200 reflects the entire subsidiary's goodwill, both Burrow's 80% share and the NCI's 20% share are wrapped up in that number.
So wow, right out of the gate, that initial decision on valuing NCI creates a $20 difference in goodwill in this case, which might seem small here, but you can imagine in bigger deals.
Oh, absolutely. It could be substantial. And as we'll see, that initial choice dramatically sets the stage for how impairment losses are handled later on. It's a critical first step.
Okay. So now we know how goodwill gets on the books. Let's talk about when assets, tangible or intangible, might well, take a hit. What does impairment actually mean in accounting terms?
Yeah, simply put, an asset is impaired when its carrying amount, that's its value on the company's books, its balance sheet value is higher than its recoverable amount.
Recoverable amount, what's that?
The recoverable amount is essentially the most a company can realistically get back from that asset. It's defined as the higher of two things. One is its fair value, less costs of disposal, basically what you can sell it for today, minus any cost to sell it.
Right, the net selling price.
Exactly. And the other is its value in use. That's the present value of all the future net cash flows the company expects to generate by continuing to use the asset.
Ah, okay. So sell it or use it, whichever gives you more value back.
Precisely. Whichever is higher sets the benchmark. If the book value is above that benchmark, you've got an impairment.
So if an asset's book value is kind of bloated compared to what it's truly worth or can generate, it's impaired. Makes sense. When do companies typically have to check for this? Is it like a constant watch?
Good question. For most assets, think property, plant, equipment companies only need to perform an impairment review if there are specific indicators that impairment might have occurred.
Indicators like what?
Well, IAS 36 lists examples. External sources could be things like a sharp drop in the asset's market value, negative changes in technology, markets, the economy, or laws, even increases in market interest rates, which affect present value calculations, or if the company's own share price falls below its net asset value.
Okay, outside factors. What about internal ones?
Internal sources could be evidence of obsolescence or physical damage to the asset. Maybe the asset is part of a restructuring plan or is being held for disposal, or maybe simply its economic performance is proving to be worse than everyone expected.
Right, so warning signs, basically.
Exactly. If you see a warning sign, you test. But, and this is where Goodwill gets really interesting, as our source highlights.
Here we go.
Unlike most assets, Goodwill that arises from a business combination, along with certain other intangible assets that aren't amortized, faces an annual impairment review.
Annually, regardless of indicators.
Annually, every single year. Whether there are obvious red flags or not, it's mandatory.
Wow, why the special treatment for Goodwill?
It's really about prudence and transparency. Goodwill is inherently subjective, right? It's not a physical thing.
Yeah.
Its value can diminish over time without obvious signs. So this annual check is a non-negotiable step to ensure its value isn't overstated on a company's financial statements year after year.
Keeping it real, essentially.
You could say that, yeah. It's a key control.
Okay, let's quickly visualize this impairment idea with a general example, maybe not Goodwill for a second. Say a piece of equipment has an $800 book value.
Okay.
If you sold it today, maybe you'd get $610, but it costs $10 to sell, so you net $600. But if you keep using it, it's projected to generate future cash flows with a present value of $750. What happens?
Right. So the recoverable amount is the higher of the net selling price, $600, and the value in use, $750.
Which is $750.
Correct. Now you compare that to the carrying amount, the book value, which was $800. Since the $800 carrying amount is more than the $750 recoverable amount, there's an impairment loss.
How much?
The difference. $800 minus $750, which is $50.
And what happens with that $50?
That asset's value on the balance sheet would be written down by $50 to $750. And that $50 loss would immediately hit the company's reported profit for the period, usually in the operating expenses section of the statement of profit or loss.
Ouch. Okay, that makes sense for a tangible asset like equipment. But Goodwill, you said it's different. You can't just sell Goodwill on its own, can you? And it doesn't generate cash flow by itself. So how on earth do you measure impairment for something so intangible?
That is the classic accounting challenge with Goodwill. And you're exactly right. Because Goodwill can't be tested in isolation. It doesn't generate its own cash flows. You can't sell it separately. It has to be tested as part of a larger group of assets.
A group.
Yeah, what the standard calls a cash generating unit, or CGU. This is basically the smallest identifiable group of assets that together generate cash inflows that are largely independent of the cash inflows from other assets or groups of assets.
So you're not looking at Goodwill alone, but as part of the whole business unit or subsidiary it came with, like the High company in our earlier example.
Precisely. For Goodwill impairment testing, the CGU is typically assumed to be the subsidiary itself, or sometimes a group of subsidiaries if they operate together. When you do the impairment review, you compare the carrying amount of this entire CGU, which includes the subsidiary's net assets, plus the allocated goodwill against the CGU's total recoverable amount. You're assessing the health of the entire acquired business unit.
Okay, testing the whole unit. And if that unit is impaired, its total book value is higher than its recoverable amount. How do you decide which assets within that unit take the hit? Does Goodwill get, first dibs on the loss?
It absolutely does. It's at the front of the line. When an impairment loss is determined for a CGU, the standard requires that loss to be allocated first to reduce the carrying amount of any goodwill allocated to that CGU.
So Goodwill takes the initial blow.
Always. Only if the impairment loss is bigger than the amount of goodwill allocated to the CGU does any remaining loss get allocated to the other assets within the CGU.
And how is that remaining loss spread around?
It's done proportionally, based on the carrying amount of each of the other assets in the unit. But there's a floor. An individual asset, like a specific machine or building within the CGU, cannot be written down below its own individual recoverable amount, if that amount can be determined.
Oh, okay. So you don't impair a perfectly good machine just because the overall unit has issues, unless the loss is really big.
Exactly. Goodwill absorbs first, then other assets proportionally, but never below their own individual recoverable value.
Okay, so Goodwill takes the initial hit. This brings us right back to our earlier point about that initial accounting choice for NCI measurement, the proportionate method versus the full Goodwill method. How does that choice really impact who shoulders the impairment loss when it hits Goodwill? This is where it gets interesting, right?
Yes, this is where the two paths really diverge and have significant financial statement consequences. Let's dive into the impairment of proportionate goodwill first.
Okay, just a quick recap under this method. Only the parent company's share of the goodwill actually gets recognized on the balance sheet. The NCI's share is invisible, sort of.
That's right. But here's let's call it the accounting twist required by IAS 36 for the impairment test. Even though the NCI's share of goodwill isn't technically on the books for the purpose of the impairment test itself, you have to conceptually gross up the recognized goodwill.
Gross up? What does that mean?
It means you calculate what the total goodwill would have been if the NCI had been measured at fair value. Initially, essentially, you calculate the full goodwill amount. This involves adding back a notional, unrecognized goodwill amount that's attributable to the NCI.
Wait, so you add something that isn't actually there on a balance sheet just for the test?
For the test, yes. It sounds a bit strange, but the logic is that you need to compare the carrying amount of the entire CGU, including the full economic goodwill, both parents and NCI's share, recognized or not, against the recoverable amount of that entire CGU. It's about comparing like at the CGU level.
Okay, so you calculate this grossed up or total goodwill. Then what? If there's an impairment loss for the CGU, how is it allocated against this mix of recognized and notional goodwill?
Any impairment loss found for the CGU is first allocated against this total goodwill, the recognized part plus the notional NCI part. The allocation technically happens in proportion to how the parent and NCI normally share profits and losses. And this is the absolutely critical distinction. Any part of the impairment loss that gets allocated against that notional goodwill attributable to the NCI.
Yeah.
It does not affect the consolidated financial statements. It doesn't reduce the NCI balance. It doesn't hit the income statement. It's like a phantom write-off because that goodwill was never recognized in the first place.
Okay, so the notional part absorbs some theoretical loss, but nothing actually changes on the real books for that bit.
Correct. However, the portion of the impairment loss allocated against the recognized goodwill the parents share that is on the balance sheet, that part is recognized. And importantly, under the proportionate method, this recognized impairment loss is attributed only to the parent. It reduces the parent's reported profit and retained earnings without affecting the NCI balance at all.
Only the parent takes the hit for the recognized goodwill impairment. Interesting. What if the loss is huge, though? Bigger than even the total grossed up goodwill? Does the NCI ever get affected?
Yes, in that scenario. If the total impairment loss for the CGU exceeds the total grossed up goodwill, recognized plus notional, then the excess loss has to be allocated to the other assets in the CGU proportionally, as we discussed earlier. That portion of the loss, the part hitting the other assets, is shared between the parent and the NCI according to their usual profit and loss sharing ratio, like 80-20, for example.
Okay, so NCI is shielded from the goodwill impairment specifically, but not from impairment that hits other assets after goodwill is wiped out.
That's the key takeaway for the proportionate method.
Let's make this concrete with that example from the source. Say we have a 60% owned subsidiary. Its net assets on the books are $250, and the recognized goodwill, parent share only, is $300. The NCI was measured proportionally at acquisition. At year-end, the recoverable amount of the entire subsidiary is only $700. What happens?
Okay, step one, gross up the goodwill. The recognized goodwill of $300 represents the parent's 60% share. So the total grossed up goodwill is $300 divided by 60%, which equals $500.
Right, $500 total goodwill for testing.
Exactly. Now calculate the CGU's carrying amount. That's the $250 in net assets plus this $500 gross up goodwill, giving us a total carrying amount of $750.
Okay, $750 book value for the CGU.
Now compare that to the recoverable amount, which the example says is $700. Since $750 is more than $700, we have an impairment loss.
Of $50, $750.
Correct, a $50 impairment loss. Now where does it go? Since this $50 loss is less than the total grossed up goodwill of $500, the loss is allocated entirely to goodwill. No other assets are affected.
Okay, only goodwill is impaired.
Now the crucial part. Because this was proportionate goodwill originally, how is this $50 loss attributed? Remember, the part allocated to the notional NCI goodwill, which would be 40% of $50 or $20, has no impact on the financial statement.
Right, the phantom bit.
The part allocated to the recognized parent's goodwill, 60% of $50 or $30, is recorded. So the parent recognizes a $30 impairment loss.
So what's the bottom line on the financial statements?
The recognized goodwill on the consolidated balance sheet is written down by $30, from $300 to $270. This $30 loss is charged against the parent's profit in the operating section of the statement of profit or loss. And the parent's retained earnings are also reduced by $30.
And the NCI.
Completely untouched by this specific goodwill impairment. Their balance in equity remains the same. So for an investor just looking at the bottom line, the parent's reported earnings take the full $30 hit, while the NCI appears unaffected by the goodwill decline itself.
That's really significant. The NCI is completely shielded from that initial goodwill hit.
Okay, now let's flip the coin. What happens with the impairment of full goodwill?
Right. Remember, under the full goodwill method, the goodwill recognized on the balance sheet already relates to the entire subsidiary because the NCI was measured at its fair value right at the start.
Okay, so the number on the books is already the whole pie. Exactly. And this makes the impairment review process, well, considerably more straightforward. All the amounts you need, the full goodwill, the net assets are already recognized in the consolidated financial statements. There's no need for any grossing up or dealing with notional amounts.
So it's more direct calculation. What you see is what you test.
Pretty much, yes. You take the carrying amount of the net assets, add the carrying amount of the full goodwill, both right there on the balance sheet, and compare that total CGU carrying amount directly to the CGU's recoverable amount.
Simpler calculation.
And the allocation of any impairment loss. If the CGU is impaired, who takes the hit?
That's also more straightforward conceptually. Any impairment loss determined for the CGU, whether it's first absorbed by goodwill or if it's larger, hits other assets too, will be allocated between the parent and the NCI based on their normal proportion for sharing profits and losses.
So if it's an 80-20 ownership split, the loss gets split 80-20 between the parent and NCI.
Precisely. Everyone shares in the pain according to their ownership stake right from the first dollar of impairment. Okay, let's use the other example from the source to see this in action. Let's say we have an 80% owned subsidiary. Net assets are $400, and the recognized full goodwill is $300. NCI was measured at fair value at acquisition. The recoverable amount of the subsidiary at year-end is found to be $500. What happens now?
Okay, first, the CGU's carrying amount. It's simply the $400 net assets plus the $300 sold goodwill. That totals $700.
$700 carrying amount.
Now compare that to the recoverable amount of $500. Since $700 is greater than $500, we have an impairment loss of $200.
$200 loss. Okay, where does it go?
First, it's allocated to goodwill. So the $300 goodwill is reduced by $200 down to a new carrying amount of $100. This $200 loss hits the operating category in the profit or loss statement.
Right. And now the attribution, how is that $200 loss shared?
Since it's full goodwill, the loss is shared according to the ownership percentages. The parent owns 80%, so their share of the loss is 80% of $200, which is $160.
Okay, $160 hit for the parent.
Yep, that reduces the parent's retained earnings. The NCI owns 20%, so their share is 20% of $200, which is $40.
So the NCI does take a hit here.
Absolutely. That $40 loss directly reduces the NCI balance within the equity section of the consolidated financial statements.
So under the full Goodwill method, the NCI actually shares the burden of the impairment loss right alongside the parent, reflecting their proportional stake in the subsidiary's overall diminished value. Seems maybe more intuitive.
Many would argue it provides a clearer picture of the total economic impact on the subsidiary and how that risk is shared among all its owners, parent, and NCI alike. It reflects a more holistic view, perhaps.
Okay, so wrapping this up, what does this all really mean for you, the listener, trying to make sense of company financials? We've seen pretty clearly how that initial accounting choice for NCI measurement, proportionate versus full fair value, profoundly shapes how impairment losses are calculated, how they're allocated, and ultimately who bears the financial brunt of that loss. Is it shouldered only by the parent, at least initially for Goodwill, or is it shared between the parent and the non-controlling interest right away? It really highlights the kind of ripple effect of these accounting choices.
It really does. And this deep dive hopefully shows that even these seemingly quite technical accounting standards like IFRS 3 and IAS 36, they aren't just about number crunching in a vacuum.
Right.
They're fundamentally about how economic value is perceived and reported, how risk is allocated between different classes of owners, and that delicate ongoing balance of achieving transparency in corporate reporting.
Which leads to maybe a final provocative thought for everyone listening. We've seen these two fundamentally different ways impairment losses get allocated, particularly hitting Goodwill. What kind of strategic implications might these choices have? Could choosing one method over the other influence how investors perceive a company's stability or risk profile?
That's a great question. Does the proportionate method, by shielding NCI initially, make the parent's earnings seem more volatile? Or does the full Goodwill method, by sharing the hit, present a truer economic picture from the start? How might an analyst adjust their view depending on the method used?
Definitely something to mull over. It shows that understanding the accounting isn't just academic. It has real-world implications for how we interpret financial health. Food for thought until our next deep dive.